Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is C.H. Robinson Worldwide, ticker CHRW. Over the next few minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. Let's dive right on in. First up, this company is in the air freight and logistics industry. It has a market cap of $13 billion and an enterprise value of $14.8 billion, so we see about $1.5 billion of net debt. Business description. It provides freight transportation services and logistics in various industries worldwide. Has two different segments: North American surface transportation and global forwarding. I'm assuming this is trucks. Truck and logistic, truckload, less than truckload, brokerage services, including shipment of single and multiple pallets of freight. Has some brokerage services that are fee-based, warehousing, smallest parcel. So logistics company transports stuff, especially around the United States, but also worldwide. Has a beta of 0.7371. That's significant because it's significantly below 1, and for an S&P 500 to have a beta that low generally suggests relatively higher quality because the low volatility is important. Now, there's something interesting here. You see return on invested capital. You have 20 straight years of profits. That's a very, very good sign for a quality company. You also see year-to-year change is relatively low, and it's not cyclical. There has been a decrease in return on invested capital over the last decade, kind of lower than it was in the 2000s. So, but it's not cyclical year to year. It's always profitable. And these numbers are steadily above 20%. Basically, you got down to a low of 15% in 2020, 18% in 2019, but back up again at 22% in 2021. So very, very good numbers on return on invested capital, looking high quality here. When you take these 10-year median returns, you see return on equity of 42%, return on invested capital of 22%. Very strong numbers, suggesting, again, a high quality company. Now, what's interesting is when you take these numbers, you compare them to 10-year median margins. We see a gross profit of 8.1%. Free cash flow 3.6%. That's interesting that they're turning such high gross profit into strong returns on equity. The only way you do that is that you turn things over very, very quickly. So each actual shipment, they're making relatively low amounts, but they're probably making tons and tons of shipments per year. So there's very high turnover in their business, which is allowing them to turn that low gross profit margin into high returns on invested capital. Very interesting setup there. Now, what we do see here is your revenue growth of 8.4% is lower than your asset growth of 12.6%. And your asset growth is also higher than your earnings per share growth of 9.2%. The way that works is it's explaining why we have lower return on invested capital over this decade than the previous decade. Well, it's because we have operated with such higher assets than we have revenue growth. That is a clear explanation for that phenomenon. Now, valuation is actually quite interesting. To get a company with return on equity of 42% and solid 8% revenue growth at 14.4 is an attractive price. We've established pretty clearly this company is high quality. So a high quality company is going to be above average from the S&P 500, but an average S&P 500 company has generally traded at a PE of 15. So you're able to get a below average price for an above average company based upon what we've seen here, which is actually very attractive for you as a shareholder. If you're liking what you're listening to so far, please hit that like button. And if you want to get more videos as I work through every company in the S&P 500, don't forget to subscribe. Ring that bell for notifications so you can get notified when I upload new videos about new companies as I work through the entire S&P 500 series. So, as we dive on into this a little bit more, you can see dividends per share of $1.34 growing to $2.08. So you're basically growing dividends around 5% a year. That's interesting because it's growing slower than this EPS growth. And I think one reason for that is when we look at EPS growth, you can see that there were some down years in 2019 and 2020. So it's not straight and up to the right every single year, which is what you'd prefer. And you have this big boost of 69% in 2021, which is interesting because it takes you up to $6.31, when if you just compare 2020 to 2012, it looks like the business is relatively flat. So I do have some concerns that the revenue growth here isn't as sustainable as you might think by looking at these numbers. And if this is a logistics company, so they probably are a beneficiary of the supply chain and the driver shortages right now because they're able to make much higher profits from their shipping and logistics during 2021 than may be normal. So that's something to be aware of when you're looking at this company, that some of these recent profits are perhaps not sustainable, especially when you see this big jump in revenue from $23 billion when it was $16 billion the year before. That 42% revenue growth has not been repeated anywhere else in the decade. So you're basically being backloaded here, and it's really hard to analyze that from just that last number. Onto the income statement. Again, you see really sustainable trends, high, gross profits, positive every year. They aren't going up every year, which is one thing to notice. You have declines in 2018 to 19 and 2022. And so those declines, even from 2016 to 2017, you have declines. So it's not just, just straightened up to the right as what you might like. Now, you do see a declining share count, and every year has less shares than the year before. So they're clearly using share buybacks as part of their capital allocation strategy. Now, the goodwill has been increasing over this decade. It's gone up by at least $1 billion. You see an acquisition here in 2011 to 2012. You see more acquisitions in 2014, 2015. It makes me think that, ongoing acquisitions is part of their strategy. And so that's kind of raising the amount of assets on their balance sheet. One of the things that I can see here is you have $1.3 billion in debt, which is more than the property, plant, and equipment. And so your tangible assets invested in this business is quite low. This is not an asset intensive business. Because it's trucking, you're probably more of a people intensive business than you are assets. Something to be aware of when you're analyzing this. Now, one interesting thing is that you have $95 million in cash flow from operations in 2021, even though this was a massive boost in net income. So a big portion here is this change in working capital. So there's a lot of working capital that was drawn into this business during that year. And they had to issue a lot of debt, apparently, in that year to make that all work. You can see this constant share buybacks. They have some stock-based compensation, $50 million to $130 million, but every single year, the issuance of they're buying back more stocks than they issue. So I'm totally fine with that as long as they're continuing to decrease that share count. You can also see that they've been paying dividends constantly, but it's not been going up every year. So the dividends have been a little bit more variable and not as reliable. So think about conclusions. This is a good business. It's a high quality business at a very good price. The only question I have is this price sustainable? Because we're at a PE of 15, PE of 14 based upon the recent earnings. But you're at a PE of like 30 based upon 2020 earnings, and a PE of like 25 based upon 2019 earnings. So what's the sustainable earnings rate is my big question. Is $6.31 from 2021 really the base that we're going to build and compound on? Or do you not have that as a compounding base? Is this like a cyclical top due to shortage in the industry? So it would go on a watch list for me, I think. Maybe. I like what I see here, but what I don't like is that you're not growing each and every year, so it's really hard for me to predict the future. So I actually might pass on this, despite it being a high-quality company at a reasonable valuation. I just can't assess COVID years here. It would require some additional research, so maybe I would do that research to really dive on in. I love the fact that you have all these double-digit numbers. I love the fact that you have 20 straight years of profitability. This could be a really good business for someone who understands this industry. But me, I don't understand this logistics industry myself yet. So for me, it would be a pass, but I think it could be really attractive for the right buyer. If you like this video and my analysis, please hit that like button. Your likes really help me to grow the show audience. And if you've been interested in this series as I work through the entire S&P 500, don't forget to subscribe. Ring that bell so you can get notifications as I upload each new video on each new company through this process. Thank you for listening. And until next time, stop paying fees, start building wealth.